said that when you are investing, rational investor is buying a government security, he will demand more for higher maturity. Means this is how in normal world people will think about. But when the yield curve having downward slope, means higher maturity yield is less than short term maturity. So that riskiness already incorporated in terms of yield on high long maturity instrument. So you need not to factor it separately, but when you are plotting yield curve, it is already factoring up to large extent about the future prospect of that country, whether it is because of political instability, or it is because of some economic activity, or because of some other reason. Yield curve captures those kind of expectations, and that's why when I started talking about interest rate, there I have mentioned several times that yield curve captures how what people think about economy. Because standing today, you are going to buy secure government bond having maturity of 10-year or 20-year. It means you will try to connect 20-year yield or 20-year instrument yield as of today. So that's why this is one of the any investment firm, if you go, they will talk about yield curve. It means they are trying to connect how people are perceiving future investment, because 10-year maturity bond probably will be maturing in 2031 if you have purchased today. So directly or indirectly, it takes care of the expectation about future growth prospect of a country. And that's why this is one of the well used and proven indicator whenever we talk about market sentiment or some other kind of proxies. And that's why this is the uniqueness of yield curve. Whenever whenever you read any paper on macro dynamics or macro economy, you will find definitely author will try to link with the yield curve or expectation on government bond or treasury bill, short term and long term, with yield, with a maturity. So that itself connect with your expectation.
Hello, sir.
Yeah.
I wanted to ask a question, a simple question, actually a confusion. Like I was studying yesterday, so I came across the fact that when there is a type of recession, or the figure is going to show that a recession is coming along in the future, so companies opt for a short-term maturity to get better interest and better benefits rather than long-term maturity. And due to this choosing of the other option, the economy or the country goes into recession. Like every company is going for short-term maturity, it will go into recession. But sir, like if we look on it the other way, like if the recession is coming along, the companies will opt for short-term maturity. How do we make sure that which is dependent on what? Like recession is dependent on companies, or companies choose for the first option on recession?
Yeah. Your point is very valid. This is egg chicken kind of situation.
Yes,
And
sir.
so it's feedback, like in electronics, when you are we read about a positive feedback system, basically oscillator versus amplifier or negative feedback system. So this is a feedback system, and you cannot have a binary answer for this kind of situation. We need to realize, like what happens when, let's say in today's scenario, if RBI assumes that inflation rate is going up. Why going up? Because when you compare the demand deposit interest rate, if inflation rate is more than that, it means the people who have put their money in the bank, they are getting negative return. So once RBI thinks that this is the situation, and then RBI use various monetary tools to address or to capture, to minimize the inflation rate in given in Indian economy, then it will have some other impact. So that's why we need to think about various dimensions, and here inflation is not only one thing. Interest rate, real interest rate, especially real interest rate, and then yield curve all put together, then only we will be able to appreciate how lending and borrowing or inflation with yield curve is going to
Yes,
be.
sir.
So it's not, that's why, one concept. So that's why whatever maximum level, I can give you, explanation. And that's why from US to Japan to China, all example I try to put in my class, so that many times you will find that this theory is not supporting in India, but probably you may get support in Chinese or Japanese context. So that's why, this topic like financial market and institution is too big. And, once you will read, we will have more, curiosity or more questions that are unclear. And as we move forward, like, when we will cover our three basic theory related to yield curve, some of you may get answer for your confusion that you might had till yesterday, today morning, basically. So with that, and that's why I gave you this assignment, so that when we are talking about different theories related to yield to maturity or yield curve, up to large extent you'll be able to connect with what you have written based on your understanding and submitted that assignment into the morning, right? So we
Yes,
will,
sir.
yeah, I think, yeah, someone has written question. Let me see. How do forex reserve help in a country in protecting the value of, yeah, see, if you have more money, let's say if you have more money in your bank deposit, so that is a kind of reserve for you. So in case of adverse scenario, in case of inflation, in case of any political risk, in case of any other kind of external risk, you will be able to keep in demand and supply as it is up to large extent, and you will be able to honor your obligation. Because when you are buying, let's say, a petroleum product from other countries, if you have reserve, at least this is a kind of collateral a company having. And that is the reason, having reserve is very important for every country. And that's why in India, if you go, government India try to keep, reserve for this kind of unforeseen event. Otherwise, even in, if you, I'm sure you must have read about Sri Lanka. Sri Lanka is facing problem related to currency. So once you read, then because Sri Lanka reserve came down drastically because of n number of reasons. Political instability, then economic instability, then country faced COVID situation. So n number of, because of n number of reasons, that problem arise. And now a country, Sri Lanka, had to devalue their currency. So that's why this is the reason why every company wants to keep certain collateral or this kind of reserve, so that for undesired event, these currencies or these reserves are going to help economy. So with this, I believe most of you are able to appreciate the concept of yield curve and interest rate. And with that, today we will start our discussion on, yeah, Anuj, you have some question?
Yes, sir. Sir, I was analyzing the yield curve of Turkey, and we see that the yield curve is sloping down.
Yes.
But we do not see any fundamental flow in the country. But at the same time, we see the yield curve of Sri Lanka, which is sloping up, but it is facing huge crisis. And we know that the long-term goal is not that great. Not long-term outlook is not that great as of now. Expectations are not that great. So why such discrepancies, sir?
You will get,
understand.
Anuj, when I'm going to talk about theory on market segmentation, most likely that theory will answer your question. So just give me half an hour or so. Most of you will be able to connect your observation on yield curve with certain theory. Three theory we will be talking about, and at least one of these theories is going to answer or justify your observation on yield curve. So I'll be sharing my screen and where we left yesterday, if you remember, this was the last slide we talked about. Now today we will discuss more on theory part, because already whether you have analyzed US versus Japan or US versus Turkey, or some of you analyze US versus China. So more, one theory or another will help you to connect with your observation, with the trend that you have seen in your considered country. So we will start with unbiased expectation theory. So in short, we also write unbiased expectation theory. And this theory is liquidity premium theory, LPT, and this is market segmentation theory. So in short, when we write, this is alternate way of representing these theories. So we will start with unbiased expectation theory, and more or less it is related with the rationality theory of investor. So what this theory suggests, that unbiased expectation theory suggests that the term structure of interest rate at a given point of time, the yield curve reflects the market current expectation of future short-term rate. So what this is, if you remember, when we talk about this kind of curve, assuming that this kind of upward sloping curve. So what we are saying, saying that we are investors are expecting that future long-term maturity instrument will have high expected return, or yield we can also call. So unbiased expectation theory suggests that the your yield curve or interest rate on a given maturity will reflect the expectation about the future growth, and that's why we call yield curve as sentiment indicator, sentiment proxy or indicator, because it captures the expectation of individual, those who are investing. And so let's discuss what we are saying, but for our understanding we will have some term that we'll be using in this chapter. First term is E3R1. So what E stand for expectation. This first term represent in which year you are standing, and this is for how many years. So basically E3R1 is nothing but the expectation of return on a security with 1 year maturity or 1 year life, purchase in third year. So what we are saying, basically E3R1 is the how much return you expect here for this year. So basically this portion expected return we are calling E3R1. Same way, when you are standing, we are calculating the expected return in this year. So this we will write E2R1 expectation in second year, for 1 year maturity. Means for this year, what is the expected return. And same way, and when we are standing here, when we are standing at t is equal to 0, means this is basically today. Basically, when today means we are talking about spot market. So 1R1 is spot market return for current time period or one time period, and that's why this is observable, because you are observing from spot market, and that's why 1R1 is the current 1 year spot market return. And when we write 1R4, it means we are observing rate here, but for 4-year investment. So this is basically for how many years? So you can assume that this is a bond, a kind of instrument you are observing, which is going to mature in 4th year. So this is what we are saying. And now coming back to this theory, this unbiased expectation theory. So what this theory is saying, that whether we buy, so in this case, you have a 4-year instrument. So what this theory is saying, either, so we should, if everything is normal, there is no unexplained factor or unexplained reason in a given economy, so we should be indifferent between buying instrument this versus this. This means what we are saying, this is 1 year instrument, and then you purchase other instrument of 1 year maturity. So basically you are buying 4 1-year bond versus buying 1 bond of 4-year maturity. You are going to be what we call unbiased, or you are going to be you will have same kind of expectation. Either you can buy 1 bond of 4-year maturity versus buying 4 different year maturity and 4 different bond of 1 year maturity. So this is what means you are going to be unbiased between these two choices. So if we put this in terms of equation, so we can put, and let's say if we extend this theory from 1 year, or here if let's say if I want to represent, so what I am saying, that you are going to buy this kind of instrument. So this is what you are going to buy if you refer to this relationship. So previous example if we take, so what we are saying, the expected return for this, first we are taking this example, we should be indifferent between these this is going to be for first year, this is for third year basically, and this is for your, so this is for 1 year maturity, buying for 4th year, this is for expected yield or interest, buying in 3rd year for 1 year, same way 2nd year for 1 year maturity, and this is spot rate. So expectation theory suggests that unbiased expectation theory suggests that investors are going to be indifferent between these two choices. And if we generalize this for n time period, so we can get this relationship. And from this, if we further generalize this relationship, basically we can get the yield for n time period, or you can assume that for 1 year, for 2 year maturity, 5 year maturity, 10 year maturity, and so on, if we know bond having 1 year maturity and expected yield for subsequent year. So this is what we call unbiased, we call unbiased expectation theory. Means investors are going to be indifferent between buying today today n time period maturing instrument versus 1 year maturing instrument having n different instrument. So this is what we call it. So now let's take this example. So here suppose that current 1 year spot rate, like spot rate means we are talking about this spot rate and expected return on T bond over 3 years, 2, 3 and 4 are like this. So spot rate is this, then expected return or interest for 1 year maturity bond in second year is this, third year, fourth year is this. Using the unbiased expectation theory current, we can calculate 1, 2 and 3 year maturity treasury security bond. So what we are saying basically, these are 4 different yield for 1 year maturity instrument. And what we are trying to get, return of different maturity. Here you see, you are buying today one bond you are buying for 1 year, one bond you are buying having 2 year maturity. So basically this is nothing but this scenario. This is year 1, year 2, and here you have in this case you have one R1 here. Here you have expectation value to R1. And what we want to know, basically instrument having 2 year maturity. Instrument having 2 year maturity using 1 year yield, 1 year interest or expected yield on 2 different instruments. And in this way, what we can get basically, if you remember, when we plot yield curve here, if I plot yield curve, for yield curve, what we need yield, and we need different maturity instrument. So here you have time period, time, or you can call years to maturity period. So what we need basically, we need these. So this basically, this return will represent, I'm assuming this is 2, this is 4, this is 6. So to plot yield curve using the unbiased expectation theory, we need all these yields. And when we plot using this relationship, because we can generalize this for 1 year, 2 year, 3 year, 4 year, up to n year, using this relationship, when we calculate different yield. So this is your observation 1. In second year it is around 2.5. For third it is how much? 2.89. I'm assuming we are somewhere here. And for fourth it is somewhere here. So when we draw this line, so basically this is what our yield curve is based on unbiased expectation theory. This part is clear, or if you have any questions. So basically what this theory is saying, that this yield curve represents the expectation about the future interest rate, and that expectation is here. You see what we are assuming, that in this we are assuming that short-term rate is lower than long-term, and that's why you see for 1 year it was 1.94%. For next 1 year it is 3. For another 1 year it is 3.74. So it means as time is increasing, delta. So in this case you see there is a change. Again here there is a further increase, and here there is a further increase. So expectation is in future, as we are assuming that in future the interest rate will go up. And there could be any argument whether as a country everything is going well, or there is a very good, political stability, or there could be some other reason. So this is what we can using unbiased expectation theory, we can get this kind of plot or this kind of relationship. Is it fine, or are you able to understand this concept? So you can think about this upward slope yield curve, and you try to frame your yield curve or your yield in this increasing year with unbiased expectation theory. So even if I'm a rational investor, I assume that in future my dollar value should go up because of certain reason. I'll be expecting higher return as I select long maturity instrument. So this is what this theory argues. And same way, like already here I have plotted. So if we draw, so we have this kind of upward slope yield curve at different maturity. So this graph we are getting from unbiased expectation theory argument. We use that what theory suggests, and then based on that we have drawn this graph. Any question do you have? Okay, so we will move forward. So this is liquidity premium theory. This is also, even when we compare liquidity premium theory and unbiased expectation theory, you may find similar kind of a kind of extension of expectation theory. So what this theory talks about, this theory suggests that investor will hold long-term maturity only if they are offered a premium to compensate for future uncertainty. So what this is suggesting, let's say in these are the expected yield on 1 year maturity instrument, which we already discussed in unbiased expectation theory. So what this theory is suggesting, that as maturity period is increasing from 1 to 3, as maturity period is increasing, investor would demand a liquidity premium. Basically, liquidity premium is nothing as some kind of return. Why return? Because they think that their money is going to be tied up for longer duration, so that's why this should be a positive number. So what this theory is saying, that when investors are investing in long duration, they expect some kind of premium, and this premium will have this kind of tendency. As maturity period of instrument is going to increase, there will be more liquidity premium or higher liquidity premium they will demand. So exactly same, if you see, if we remove this part, if we use all these as 0, so in this scenario your unbiased expectation theory will give same kind of result with liquidity premium theory. But when we change that, liquidity premium will be something, a positive number or some positive return. So in that case, your expected return should be further adjusted for demanded liquidity. Initially, if you remember, in 4-year case, what we said, that return will have your resultant yield will be like this. But in this case, because in second year, when investor, for first year investor will not ask any liquidity. Reason is very clear, because this return is observable. 1 year return is observable because it is very short time period. But second year, when he is buying instrument at the end of first year for holding it, because he will be buying one instrument here for holding for another time period. So he will add a liquidity premium, because one additional year his money is going to be blocked and expected return is this much, but liquidity premium will be L2. So same way it is going to be there. And so this was 4. So same way, like, in unbiased expectation theory, if we keep, adding this, adding liquidity component, we will get, one relationship, and from this we can easily calculate the, yield considering the demanded liquidity by the rational investor. So this is very similar. The only additional, component or, item that we need to adjust here is liquidity premium part. And, one example we will take, if you remember, say this example we have already taken. These were the, expected yield. But let's assume that in second year, investor demand 10 basis point of liquidity. Remember, 1 basis point means 1% is equal to 100 basis point. Or in short we write BP. So basically for second year, investor is demanding 10% basis point liquidity premium. Second year 0.2% or 20 basis point, and for third to fourth year it is 30 basis point. So what we are observing, this kind of trend, and all are positive because investor is investing for one additional year, and that's why he is demanding 10 basis point, 20 and 30 basis point additional liquidity premium for second, third and fourth year of investment. So using this information, when we calculate exactly the same way, the only difference here is you have L2 here, you have L2 component, and this is L3 component. This is L2, L3 and L4. So when we calculate, these are the return. And when we draw this here, so what we are observing, if you remember the previous curve, let me see, it was 2.47. Here you see 2.47, 2.89. So all three were less. So within this, if I use, if I draw it, so this is basically unbiased expectation theory curve, and this is your liquidity premium theory curve. So you can see that this gap between these two is coming because of liquidity demanded, liquidity expected or demanded by the investor. And that's how, your curve slope will change based on how much liquidity investors are going to demand, based on their perception or based on their risk level. This part is clear?
Sir?
Yeah.
Sir, I have one doubt that earlier when we started with this problem of yield curve, suppose we are talking about 4 years, then we had 4 variables to find, like the rate at 1, 2, 3 and 4 years maturity.
Okay,
and
let me go
using
back. Right.
And depending on which theory we are subscribing to, we now rewrite it in terms of some other variable. Like in the first one, we used E1, E2, E3, E4. Sir, I want to understand like how is this helping us? Still the number of variables is the same. Like, is it that these values are more easily available to us?
Actually, you think about this way. Let's say a bond is available, a bond, 1 year bond, 1 year maturity instrument, treasury bond or treasury bill is available, right, today, and that bill is offering, this much return. And this return, basically, this return is, we are expecting that treasury bond that will be traded at the end of first year. This is based on expectation, based on certain, assumption. And same way here. So what assumption, if you look at all these numbers, what assumption we are making? We are making that, there will be same type of macroeconomic condition, and the expectation of rational investor will be the same. Means there could be no different type of expectations. Some investor will have different kind of expectation. They want, I'm least bothered about what is happening in second year, third year, or fourth year. I'm more worried about 10th year. That is not the case. So in this, with given the other scenario or macro factor or behavioral factors are the same, not going to change, these are going to be expected return. These are not observable. That's why E we are writing. But we are assuming that 3%, 3.74% and 4.10% with certain assumption and some speculation you can think of.
Okay, sir. So from this, if I am making the statement that it's like there are more reliable methods to like get to these expectation values compared to directly arriving at R1, R2, R3, R4. Hence, we are going this way. Like first, we are calculating expectation values of 1 year bonds, and then we are using them to calculate the.
Yes. So here, basically, you let's say I'll make it more easy. So let's say this is representing your 1 year bond. This is representing your 5-year bond. This is representing your 10-year bond, and this is representing your 20-year bond. And now we want to calculate, these one, because there should be some basis, right? So let's say I want to know what should be the yield of 1-year maturity bond, 5-year, 10-year, 20-year. So how it can be calculated? It can be calculated using this kind of relationship where we assume that one year ahead, what could be the expected return on 1-year maturity instrument, and then using our a normal calculation approach, using the geometric series, we calculate these different maturity instrument yield. Right, because directly arriving at some number, let's say if I know that a spot rate is 2%, how I can say that what should be the a rate for 5-year maturity instrument on today? There should be some basis, and that basis basically is coming from here, that we know that what would be the one year maturing bond in 2nd year, 3rd and 4th year, and using their rate or their yield, I can calculate different maturity instrument, and using all these we can basically draw yield curve, and yield curve will be like this: 1 year, 5 year, 10 and 20 year. And when we draw, we are getting this kind of relationship. So I know there, because this is not something which is well known. Well known means it's not black and white. There are lots of subjectivity in there. What would be the number? Because when we use expectation or expected value, already a vacuum get created in our mind. How we are going to get that number?
Yes.
Whether number we are expecting 3%, whether it is 3% or it is 2.4%. So yeah, with that, but again, to understand theory, we'll have to have some assumption, something we'll have to relax, and we'll have to believe that these are the number. And you can think about, these number may be different. Let's say in case of Turkey, probably this kind of, in case of Turkey, if you go, you will find this kind of downward sloping curve. Or in certain case, you may find kink shape yield curve. So let's say it is also possible that here it could be 2%, here it can go to 1.5%, and here it can go to 1.2%, and for subsequent year it may go to again back to 3%, let's say 3.4%, 4.2%. So this could also be the case. But if that is the case, then these number will change, and then probably rather than getting this kind of upward slope, you may get this kind of curve. Right, so that's why I'm saying it's not this is something which is you will find certain subjectivity. Of course, model that we are using, basically this calculation part, is we are using basic mathematics, but there are certain assumption about the expected value. So with that, I think we generally will have to live with certain assumptions. So this is what assumption we will have to consider. So and any question related to liquidity premium theory, basically, yeah, here we were. So these two theory and the gap between these two, you can think about this L, this liquidity premium part. If you think that liquidity premium for second year, it should be 20 basis point or it could be 40 basis point. Again, that is something which is based on assumption, whether 10 basis point every year liquidity premium should be considered, or 20 basis point. So people may argue, this is what my assumption, and that's why when somebody writes theoretical paper. Theoretical paper means mathematical model with simulation, because we find two type of articles. One article that use the current data set or historical data set and shared observation. So we call it empirical paper. And another set of papers are there that are based on theory, core theory, and in theory they do simulation. So let's say if we simulate that the change, so let's say n plus 1 would be this plus 10 basis point. This is one assumption, means every year as number of years are going to change, my increase in the liquidity premium will be by 10 basis point or 0.1%. Someone can say no, there will be some delta between delta of previous 5-year or previous 10-year variation in yield or in trend. So there are n number of ways by which L can be calculated or L can be assumed, liquidity part. But for understanding this, we are keeping that liquidity premiums are known, and this is how it will keep on increasing over the period of time. And then we have compared these two theories. Now this is what this curve, if you relate this curve, so this previous curve that we talked about like this curve is basically here, upward sloping. It could be downward sloping as well. Here you see, this is your curve you are getting from unbiased expectation theory, and this liquidity premium, because in liquidity premium what we are assuming that this kind of relationship, as this delta, or it is going to be 1, 2, 3, 4, 5, 6. If that is changed over the period of time, liquidity will keep on increasing. If liquidity is keep on increasing, your unbiased expectation theory may have this kind of slope, but because of liquidity part, it will have upward slope. And second, when you have flat, means there is no change in the expectation about the future return. So even as with the year, your L value is going to change. Here L value could be 10 basis point, here L value could be 20 basis point, here value could be 30 basis point, and so on and so forth. So as term to maturity is is more, liquidity premium, expected liquidity premium will be higher, and then based on that the gap between these two will keep on increasing. And one argument could be, let's say if after 50 years, why we are assuming we having this kind of almost parallel relationship between these two, because you think about a scenario where you buy a bond of 50-year versus you buy a bond of 60-year, you are going to be indifferent, because 50-year and 60-year seems more or less very long time period, especially when we consider your investment horizon. So that's why adding 5 basis point or 10 basis point doesn't change your investment decision. Investing for 50-year versus investing for 60-year, you will think anyway I'll be enjoying my coupon for 50 and 60 years, so why I should be worried about what would be the liquidity difference between 50 and 60 years. So there are various arguments, but these two theory will help you to to relate with your graph. Now this is the last theory and third theory, and this theory is totally different from previous two theory. In previous two theory, our assumption was that investors are rational. They will take they will consider investment with certain assumption, and with that assumption they are going to select, they are going to ask for more demand. But market segmentation by term itself, what it is suggesting, that market itself is segmented. So what that segmentation we are talking about, we are saying that there are market where people are ready. This is, let's say, 5-year, 10-year, 15-year and 20-year. So what market segmentation theory suggests, let's say in market we have these different type of instrument available. In previous theory we have not said that market is segmented. In previous theory we said investors are rational, they will see whether they are investing in 5-year versus investing in 10-year versus investing in long year maturity instrument. So one investor can invest any of these maturity instrument, and based on their expectation and liquidity premium expectation, they will expect their yield is going to change, or their expected return is going to change. But in this theory, what theory is saying, that market itself is having segmentation. There are different maturity instrument, and there are demander. There are separate demander, individual. Let's say here you have I type of investor, I class of investor go and buy 5-year, J type of investor go and buy 10-year maturity bond, K type of, and L type. Means your market itself is segmented, and there are different individuals or different investor who having preference on different maturity instruments. So I type of individual investor will only invest in 5-year maturity instrument. It means based on, remember, your based on demand and supply schedule, rates for 5-year maturity instrument or yield on 5-year instrument are going to be decided. This J set of investors are different. They are only interested in 10-year maturity bond. Why? Because their liability, let's say after 10 years, right now, let's say somebody is there who is in 50 year, and he is going to retire in 60th year. So here 10 years gap is there, and he thinks that in 60 year there will be he will be requiring lots of money. So what he can do, why he should buy 5-year maturity or 15-year maturity or 60-year maturity bond? What this type of individual will do, they will go and buy a 10-year maturity instrument. Why? Because their liability is future liability is going to match with this type of instrument. So they are only worried about 10-year maturity bonds that are available in the market, and they are least bothered about 10, 15, 20 or 5-year maturity instrument. It means market itself is segmented, and based on the demand and supply for these instruments from these demander, yield is going to be decided. And that is the this theory is totally different from previous two theories. And that's why you can have any type of, you can think about relationship, let's say 5-year, 10-year, 20-year. Let's say more demand is there for 10 years, so here you will have high yield. There is less demand for 5th year, and there is least demand for 20 years. So probably you may have this type of curve, or you can think of another scenario where low demand low demand for 5-year, high demand for 5-year, and for least demand for 10-year and highest demand for 20-year. That could be also scenario. So you will have U type or J type of pattern in your yield curve. So that's why I said that this theory, market segment theory, will be able to answer your all the question, all the trend that you may have observed in your yield curve. And here you can see the relationship. So you can think of this is yield on short term bond, or short a 5-year bond or 1-year maturity treasury bond you can think of. So the supply is same, and this is your demand curve. So based on equilibrium, this is your going to be yield on short term instrument. 5-year you can short, let's say 5-year, and this I'm assuming this is 10-year and rational investor are there, and investor thinks that 10-year should have more return. So they are demand. So the expected yield is this. You can think of RL. So when we plot this yield curve, this is what your 5-year rate is there. You can think of this 5-year, and this is coming from your 10-year. So this kind of upward slope curve we are getting. And same way, if the demand for this is low, or because of supply and demand situation, this is what interest rate on 5-year, and demand is more for 10 years. So the rate is this. Then you may have steeper relationship, or this kind of yield curve. So you can think of this is only small and large we have thought of. You can think of in between. You can think of 3 months, 1 year, 5-year, 10, 20, 30 years. So this kind of theory, if you put demand and supply schedule, connect with the segmentation theory, market segmentation theory, then you may have different type of yield curve. So this is what uniqueness of yield curve, and these theory up to large extent confirms or suggest you the possible trend or possible shape in your yield curve. So I think these theory can tell you your shape, yield curve shape could be anything because of different reasons. And market segmentation theory is one of the theory that helps you to understand dynamics between various class of available instrument in the market. Yeah, and any question? So we will restrict our discussion up to this slide. If you have any question, I will take. Otherwise, we will meet tomorrow. Yeah, any question? Any
Sir,
question?
Could you explain once again the demand and supply curve for this short-term and long-term security?
Okay, yeah, fine. So let's say, let's say we assume that this is for S stand for short term. So this is demand and supply schedule, you remember. So we are assuming that this is how your demand is, their demand curve. This is your demand curve. And we are assuming that, let's say, this is static supply, right? Or you can think of this, the government is providing, 5-year maturity bond, this type of supply is there. And using the demand and supply schedule, the rate, the intersection point is going to be the yield on your instrument. So this will become your yield part, how much return your instrument will give based on demand for 5-year maturity or short-term maturity instrument versus the supply. So here what we are seeing that rate for 5-year is less, and similarly, and here rate for 10-year is more. So this, if RL and RS, if I write, so what we are saying here, this short-term yield is less than long-term yield. And when we draw, basically these are two different demand and supply curve. When we connect both, when we overlap both, so this is what we get. This is this curve. So this curve suggests that yield curve for 5-year, this is the return RL, RS, and this is your RL return or yield on 10-year. So this is your combined, you can tell that this is your combined graph based on long-term and short-term supply and demand curve. And here also, if you want, you can, here itself, you can draw demand and supply for both. So this will be demand and supply for short. And this will be demand and supply for your long term. So this will be DL and this will be SL. So basically, this is the combined curve, and that combined curve is giving you the yield to maturity curve direction or trend. And this is another example. Here, steeper rate is short term is very less as compared to this. You can think about, this is, let's say, 1% and this is somewhere 5%. So here you will get more, high, the slope is higher than previous one.
So how are we maintaining a constant supply? I just wanted to ask this.
It could be different, here, because your supply and demand curve could be like this as well.
Yes.
Just for interpretation, we are assuming that, let's say, government has planned to issue 20 crore 5-year bond. Let's say, hypothetically, we assume. It means already your supply is decided. And then you will, so that kind of assumption we are making so that our interpretation is going to be easier. Otherwise, in reality, if you, remember our discussion previous,
yes,
we have seen, your demand curve can also move, your supply curve can also move. So we are not, going into that, complex, understanding. But when we know, this kind of simplest framework, then you can extend to more complex scenario.
Okay, sir.
Right. So I believe, you all are able to understand this concept. And if you have still any question, you can, we can discuss in tomorrow's session. And I think, Utkarsh.
No, sir, I was just saying that like the questions will come tomorrow, I guess.
Okay, fine.
The concept that you were studying today.
Right. So you can also go back and see what you have submitted as an assignment and whether the theory out of, these three, which one is more appropriate in explaining the relationship. Fine. So I think with this, I'm concluding today's session, and we will meet tomorrow and try to complete, this module. Thank you.
Thank you, sir.
Thank you.
Thank you, sir.